Chapter 1: Working Capital Management. The main tools available for Treasury managers to use when optimizing capital are summarized as follows. Supplier terms, or deferred payment. This basically involves our business requesting credit terms from its suppliers for goods and services already received. If our business is able to receive raw materials from its suppliers and then receive payment from its clients before paying its suppliers, it would have unlocked cash during this period between receiving payment and paying suppliers. This unlocked cash could end up being a significant boost for the cash flow efficiency of our business and could be deployed to fund short-term operational objectives. This unlocked working capital is the cheapest possible option for funding ongoing operations. Efficient payment processing systems. Our banking or payment service providers should clear funds due to us as quickly as possible and with the least possible cost. It is important for us to shop around for the best service providers in the market. Client prepayments. Similar to deferred payment of our suppliers, our business could unlock significant amounts of capital if it was to offer its clients incentives for prepayment of goods and services we provide to them. Incentives may take the form of discounts on goods sold or better delivery terms. For example, shorter delivery times if the client were to pay in advance. Debtors discounting, also called debt factoring. This involves raising money on the back of our business's debtors book or accounts receivable book. Our business would raise money from an institution called a debt factoring company and transfer ownership of our debtors book or accounts receivable book to the debt factoring company. The debt factoring company would provide funding to our company at a value lower than the value of the debtors book, and would therefore buy the debtors book at a discount, which would then represent the rate of interest on the transaction. The debt factoring company would subsequently be repaid by the clients or debtors on our debtors book after we had sold the debts to them. The level of discount required by the debt factoring company would depend on the credit quality of the debtors book of our business. The poorer the credit quality, the higher the discount required by the debt factoring company. For example, a debt factoring company may offer a business $9.5 million for its 1-year debtors book, valued at $10 million. If the credit quality of the clients was good, this would represent a circa 5.3% rate of interest on this transaction. However, if the credit quality of the debtors book was poor, the debt factoring company may only offer, say, $6 million in funding in return for the $10 million debtors book, and this would represent a circa 66% rate of interest on the transaction. Working capital debt facilities. Banks provide working capital facilities which work similarly to overdrafts. Working capital facilities are typically granted for 1-year tenors, but are automatically renewed annually, provided that the credit quality of the borrower has not deteriorated materially. Businesses are able to draw on the funds when needed under these facilities and pay down the facilities when they have excess cash.